This panel is financial inclusion and impact investing, and I know that is supposed to be a main topic, and we have spent a lot of time on microfinance, and I think this is sort of the natural next step of where does microfinance, fit? What is impact investing? What does this all mean, and why are we talking about impact investing? And so I think each one of my panelists here can give their own involvement in impact investing and their thoughts on how it has evolved and moved forward. And I'm just going to start out with a couple of questions and then basically let each of you sort of take it as you wish and also respond to questions from the audience so that we make sure that we address key concerns, because I think everyone has some concerns as well as a lot of enthusiasm. But I would say from my perspective, having been involved, again, in microfinance for over 25 years, primarily on the capital markets side, initially with Michael Chu, working on guarantee funds and trying to do securitization and moving forth, but always with the intent of bringing capital markets to bear on the microfinance sector, because that was the key way to scale and really assure permanence of the institutions and the great work they were doing. We're now, I think, at a stage where I would say, and reflecting back to what, I can't remember who actually said this, I think it was you, Sanjay. I sort of feel, this is me personally, that we're at a stage of a bit of irrational exuberance about impact investing. And at least when we were at a period of irrational exuberance about microfinance, we knew what microfinance was. Right now, I sort of feel as if there's this incredible exuberance about impact investing, yet if we went around the room and I asked each one of you, and we don't have time to do that, what is impact investing? My guess is we'd probably get a different answer from everyone, or you'd copy the next person in front of you. And so I think, what I think we would start out is, first of all is, I feel like at least initially with impact investing, microfinance was actually not considered impact investing. When early on there was a group that created something called the IRIS framework of terms and trying to really standardize the way investors could look at all various types of investments across the spectrum of impact investing. I went down to New York, sat in a meeting. I was representing Root Capital, so another enterprise, but there was only one other person that was there to discuss microfinance, and that is your wife, Sanjay. Frances was there. And basically what we were told, I didn't actually talk to Frances about this, was that really we don't really want to talk about microfinance. It's like that's kind of done and everything, and you guys are sort of, so you could actually leave the room, and I was not invited back. And so there was this divide early on that I felt that microfinance is something that may be considered legacy, and impact investing was going to be the next big thing. Now, if you look at the GIN report, which I don't have in front of me, so I can't quote, I think there's massive amounts of money flocking towards impact investing, and I believe there is some comment in there that says that the bulk of it is going to microfinance. So now I'm confused. Where microfinance fits if it's not impact investing. Interesting conversations I've had, and I'm going to ask Roland to also sort of comment on this, is that the microfinance has become in some ways a not such a great word to use. So I work for the Center for Financial Inclusion, so we are all working in financial inclusion. We're not really using the word microfinance, whereas in other parts of the world, maybe in Europe, microfinance is more accepted and has a meaning, and people are looking to say, I'm investing in microfinance. So again, one needs to take a more global look. But I think, it's not 100% clear to me, what, and this is where I want to hear from everyone, did it make sense to, do we really believe about all this money going into impact investing and that there is, a real trajectory for impact investing? What does that really mean? Does it make sense to open up a space named impact investing? Does it need to be addressed separately from microfinance? And I think what I will actually ask each of my panelists is how do you define impact in impact investing? I think that will sort of start us off on a overall discussion, and then again, look forward to hearing from all of you. So
I'm going to say that it doesn't really matter how I define or how Microvest defines impact investing. What matters is how our investors define impact investing, because that's really, the term impact investing is really an investor structure for how investors are looking at deploying their capital. I do think that there has been a long trajectory over the last 3 decades, probably a little more advanced in Europe, certainly, with socially responsible investing. That's become a large segment of the investing capital in the United States as well. So I view it as sort of this outgrowth from socially responsible investing to kind of people that have a global view, that are interested in deploying their capital in a way that aligns with the way that they view the world. So that means that there isn't any one definition of impact investing, which makes it very difficult for us to position ourselves as an impact investment that fits everybody's definition of impact investing. So my experience, and I'm not responsible, probably luckily, for the fundraising at Microvest, but I do periodically engage in meetings that we have with investors and on investor calls, and it's really about a conversation of where we see the work that we do and the investments that we make in financial inclusion, or low-income finance, which is the term that Gil Crawford coined that we use, why the social impact of the type of the companies that we invest in is positive in their communities, kind of how we define our investment universe, and why that provides an investment opportunity for our investors, who are high net worth individuals, family foundations, institutions, primarily in North America, why it provides an investment product that can fit into their objectives for socially responsible impact investing, whatever they happen to call it in their philosophy.
Are we going this way?
No, I just wanted to say that this is very interesting, but probably doesn't help to clarify what we are doing, because investor perception can be something pretty strange, pretty non-understandable. I told that story quite a few times, but well, my job is to structure microfinance funds or social impact funds out of Luxembourg, and sometimes we really have strange experiences with investors having a kind of very special view on what social impact is. And so when you are, dealing with an US pension fund and a European insurance company, and that the European pension insurance company, says, yes, I want impact, and by the way, the manager is going to be remunerated by a carried interest, but only if social performance has been measured and tick the box and everything, and otherwise I'm not going to invest. And then the US pension fund saying, this is bullshit. I don't believe in social performance measurement and whatever. I did my due diligence on the manager before I decided to invest, and so I'm confident that the manager will match what I'm looking for. You are just, as a fund structurer, sitting 6 months trying to get both under the same roof. So yeah, it's the reality, but it's not rendering the whole story easier.
Yeah, I mean, I would agree that impact is definitely ambiguous. I think not just for investors, though. I think also in investment managers. And I think it really comes down to your theory of change. So if you're looking to just expand access, then you'll look at companies that can scale, and you'll only look at outreach numbers. If you're looking to expand access in order to improve people's lives, then you have to, like we are, then I think you'd have to go further and define impact that way. So I think it's just important to have those conversations up front and be very clear about how you're defining it, how the portfolio companies, potential portfolio companies are defining it. And since primarily we invest equity, it kind of affords us that opportunity to become partners, long-term partners, and help sort of guide the company and its activities to achieve, hopefully, the impact that we're all looking for. But you have to be aligned from the beginning and not sort of fit this ambiguous impact cloud over everybody, regardless of whether that's their business model and whether that's their mission. So I think just important to differentiate.
And what I can say is that in Europe, what the GIN calls impact investing, we call it sustainable finance. So just to add, but it's exactly the overlap is almost perfect on those two concepts. Another interesting thing is, so we structure debt transactions for funds, and when you do it in the U.S., the fund manager says, it doesn't matter if it's an MFI, we just don't want to call our fund microfinance. And in Europe, it's exactly the opposite. If you show him MCOPA, he says, well, it doesn't matter what it is, as long as you call the fund microfinance. And I think it's because there's a different experience from investors. There's also a different echo, I think, of the press or of universities or of the narrative, the big picture narrative that's behind the industry. Another thing I could say is that we've seen this as cycles. So when I started, we talked about microcredit, and then we talked about microfinance, and then we talked about inclusive finance, and then we talked about impact investing. And so the investor is completely confused, that's for sure. And so we tell him it's all the same thing. And we really try to insist on the fact that it is all the same thing, and it doesn't matter how you're going to name your fund. We're talking about private investments in emerging and frontier markets that target the base of the pyramid, through financial services. And so that for us is the definition that we actually put in our prospectuses. And we say any intermediary that has more than 50% MSME or what we call LMIH, so low and middle income households, is sufficient. It's a very broad definition, but it's a one-size-fits-all. And looking at some of the discussions we had in the panel before, if you need to onboard a Mi Banco or an MCOPA or a Tala Mobile or God knows what model. We're even looking at a TriLink right now, who's more of a SME loan fund. They all fit under that category. And the investor always tells us, again, you're in charge of choosing the credit risk for these debt funds. And as long as it goes to the base of the pyramid and it goes and you're pushing money in countries where the capital normally doesn't flow, well, that's good enough, because that's what we want to see. And then, of course, there's a discussion on risk and return. So I would say, as a long answer, I would hope that we can. Well, my proposition is that we would come out of this day saying, there's a basic definition and it's all the same thing. It's just that we're telling the story differently. There's a different way or different narrative about talking about how we're pushing capital, outside of saturated markets, trying to deleverage a bit our economies possibly, and bringing it in countries where there's a very high capital need. And that the deeper we go with the capital, the better it is. So yeah, that's a bit my take. But I think it's fundamental. I was supposed to be the moderator on the next panel, and that was going to be the topic of my discussion. So now I'm confused because I'm not sure what I'll talk about after this. But if we need to start as an industry with one thing, it's really this definition, and it is fundamental. Because we are confusing the investors more and more, and we're taking the risk, and the discussion on the private equity in MFIs is one example. We're taking the risk of sort of exhausting them, and that they don't want to come back. Whereas it's very clear that there's a very high need for equity or for whatever capital coming to us.
We have very similar business models, and we've. And I think that however we define our business parameters, and we're very clear on kind of what we do. And this may not be as much of a challenge in Europe, But I think that what we confront, at least in the North American markets, is if we're talking directly to an investor, it's very easy for us to explain kind of what we do. Kind of our business proposition is very clear, and it's understandable. It's when there's a intermediary or a larger objective of the investor to kind of put this investment in a particular bucket, and they've got their strategy on we're going to do X amount in impact, however they're defining that, and Y amount in something else. And I don't believe that you're a normal enough investment for me to just look at the merits of this particular deal. I have to put you in a bucket. And I think that really is a challenge that we have in raising capital, continuing to raise capital, whether there's that direct appeal or whether we're being confronted with a structure where that definition of what impact investing means depends on what their thought is.
It's also funny to observe that traditional, and maybe you can challenge me, but what I observe is that for traditional microfinance managers, you are hearing me, yes, is it okay? It's difficult to position themselves in the impact investing sphere, and what we observe is that these managers tend nowadays to position themselves in the normal private equity sector and waiting for investors to have a special demand with respect to impact or results, outcomes of investments. But from a commercial point of view, they are positioning themselves in the traditional private equity sphere.
Let's hear from Ami, who really is, and what I would say, very involved in impact investing.
So if I wear the current hat that I have now as Elevar, we get often asked the question from LPs, because we're currently in the market right now, raising our fourth vehicle. Are you going to go to the market as an impact investor, or are you going to go to the market as a traditional VC firm? You have a track record, you have a strategy that's proven, et cetera. And it's a hard question to answer because in the traditional VC allocation space, we're still emerging markets. We're in India and LATAM, two geographies that most allocators have a hard time allocating to in one vehicle. So we face a lot more of the more traditional allocation hurdles. So going to Candace's point of, you have to meet with intermediaries and sort of convince them. And we're venture on top of that because we will write checks pre-revenue, right? So we're taking venture-like risk, but we're not investing in technology companies like Silicon Valley's investing in technology. So the definition, there's confusion around the definition around venture. And then when you get into the impact space, we have 3 funds. Our first fund was about $26 million and it had 99 investors. And so that is the nature of this space, is that it's a lot of family offices and individuals that have committed their own private wealth to make a difference. And the mandate of that fund was to prove that you can invest in these endeavors and make a financial return. So, that whole concept of no trade-offs, we believed, right? And so the customer base that we're serving is the customer base that we all are serving and have been serving in our careers from the very beginning, and we're saying they are a viable customer base. We're finding the right entrepreneurs to serve them. The second fund was a $75 million fund, and it had a smaller base of investors, about 15. But then Fund 3 went back up to 40 because we had to go through wealth management advisors, and so there's the pooling. You have one advisor, and you have like 10 clients behind them, and I was previously one of those wealth advisors that was doing that. And so you can't count on LPs the way that traditional private equity and venture capital funds count on LPs to come in because shops closed down. So one of our LPs was JP Morgan. They no longer have an impact investing allocation platform. So the consistency and the constant review within the impact investing allocating space is a challenge. It's a risk when you're looking to be a strong funded LP that's like driving mission. if I put on the hat of my prior job, which was Imprint Capital, our job was to create customized impact portfolios across asset classes for a variety of clients. There you fall into impact investing is not just financial inclusion and social. You're also then competing with environmental endeavors. And then when you think about it from an asset class perspective, you have public equities, fixed income, and then alternatives, which is what we're in. And you're forgetting we have the real assets. And then you have the dimension of US versus emerging markets. And so it's not just we're competing within our own segment of financial inclusion, we're competing against an entire broader universe of sort of impact investing space. And so that's the complexity that any new wealth advisor has to swallow. Things that we know and we've lived with for the last 10 years is new nomenclature for them. And so there's a significant amount of education that has to go in. And then you have the whole no trade-off, and then you have the concessionary, right? And so a 4% rate of return on a fixed income product in Europe is actually market rate, can be defined as that. No one in the US would ever put that on their product offering as a market rate return. So then you have the divide of sort of how do you then position these products to sort of then fit into the buckets that people are allocating against. And so I don't think there's an easy win. There's no silver bullet. I think as practitioners in the space, it's every opportunity we get to educate people further. That's sort of the way that this moves along. But these are hard challenges, and so we just have to keep pushing. For Elevar, impact is defined as we are serving a constant customer base and meeting their needs. And so therefore, everything that we screen is impactful. The metrics that we define are embedded in the business model. They're not, you don't wake up one day, think about impact, and wake up the next day and think about financial returns. Like, that is not the way that any of us should be approaching this. And so that's sort of the philosophy that we have.
Great, thanks. I think what's been interesting to me over the last few months is that I have heard of more than one sort of fund manager say that they were dropping the word impact because it was creating more confusion and actually alienating people, because so it's like, now where do we go? And I think that's really out there.
I'm speaking now as IGNIA Fund, which Ami knows very well. In her previous incarnation, she was one of the LPs of IGNIA 1. We are deploying IGNIA 2, and I want to say that we are one of those that ceased calling ourselves impact investors, although since Fund 1 was started in 2007, some people thought of us as a pioneer impact investing fund. And the reason we stopped calling ourselves impact investor is precisely reflected in the comments on the panel. It is more confusing than clarifying. And one of the problems that I think is very important is that for some, the mention of impact investor meant they're going to provide bad returns but try to save the world. And so we tell people, this is what we do. We're venture capital looking for disrupting models that will deliver goods and services to the majority of the people in Mexico. But what I think it's interesting now with my academic hat is to say, why create a new term? And I think the imprecision, if it's to respond to investors and sort of say, this is something that might interest investors and we ought to be part of that, reminds me of institutions that were donor dependent and then sort of say, I'll wear whatever clothes it is. I'm going to do exactly the same, but I'm going to wear whatever clothes will bring the donor. And that is part of the problem, I think, in not defining it very clearly when you're basically bottling old wine in new bottles, because then it's very confusing. And for example, the gin report, which was mentioned, for several years, I've thought that the only way to get to those numbers is bottling old wine. And so deploying in the field, I think it's very lonely. And all those billions are where they always were. And so the question is there a sense in creating a term? And for me, it does make sense, but if you narrow that definition, and it makes sense if it's something new. And so I think that's the only reason why one should use that term. If not, we should forget about it.
So how would you define it?
Well, I think, in my view, there's 4 elements. The first element is the deployment of the practice of investing, which we all know what that is. The second is before the presence of commercial markets or players. Third, in the delivery of an intervention that seeks to provide a measurable way to influence a specific problem. And fourthly, providing commercial returns to the investor. And I think if in this definition, you would exclude investing in Compartamos today. It's microfinance, but it doesn't fit any of them. And so on. And admittedly, this is geared a lot to venture capital, and so it has the lens of that. So I think you could expand or amend it, but I think if you look at that, then it's truly innovative, because it says, I'm going to try to affect a social problem through a commercial platform. And the reason for that, in terms of theory of change, is what, at least for me, was the big lesson of microfinance, that if you mount an intervention that has positive impact, then if it's a commercial model, i.e. able to deliver commercial returns, and my definition of commercial returns is not academic. It's whenever you have somebody else joining you that is attracted to be in the same field. Then you really move the needle.
Maybe maybe just a direct reaction to that. And I, I agree, and I would, as I said, I can only promote a sort of single definition. What's missing from that definition, I would think, is that we're thinking about the project, but not about the client, the investor. And I think that's something that's missing from the conversation a bit of what's the demand of our client. And
What's
so,
the demand from the investors coming in?
Yeah, of course, the client being the investor. And so,
Yeah.
But if it's just that, why are we talking about solving a social problem? So
Because that's what you do. You're aiming an intervention. That's what separates it from something else.
But if that's the point, should we even communicate about that to the investor? And I'm not saying I have answers, but I think it's very important to stop always trying to see what the money's put at work, but why the investor needs to put that money at work there. And if we go there, suddenly we realize that there are retail clients, and usually they just want to be above money markets with, if it's microfinance or impact investing, they love to see a story, or to be told a bit of a theory of change, if we want. If it's a private bank client, he likes to be involved. He wants, maybe you'll have to put a bit of sub-debt or local currency because he wants to see a bit of volatility. He gets excited. He looks at his portfolio. And if it's an institutional investor, he's really looking at the big picture. He's an economist, and he needs to understand that it makes sense to be pushing money into Cambodia and trying to understand what's going to happen in 30 years. So I think it's really important that this industry focuses on its clients, the investor, and then suddenly thinks maybe we need to segment a bit the story. And of course, one word or one expression can't coin on all of that. And as I just said, I'm rooting for microfinance because it has the merit of being there, and and a lot of investors hide. Yeah, and a lot of investors have identified themselves to it. But anyway, the point is, I think, is that we need to think about why the client is doing this, and is there different types of clients?
You say, Robert, because I think what you're saying is, how do we define what we do? Are we trying to serve the needs of investors, and so that they can deploy, or are we trying to serve the needs of investors, and that's our market? Or in another way of using capital markets is, this is an activity that I'm doing, and I'm going to try to raise money for the activity I'm doing. So those are two different things.
Well, no, but precisely. I think the magic of what we're trying to do is we're trying to do both at the same time, and we're trying to help our client be conscious of his decisions. That's sustainable finance. It's telling him, you're not just dumping money in a bucket and getting 6%. Your 6% has consequences, positive or negative. And it can have dramatic consequences or positive ones. But our clients are consumers who are not aware of the impact of their consumption, of these investment funds. And so we're trying to educate them to say, you're going to get your money market plus, but by the way, it's much better to put your money here because it actually goes in the right direction of SDGs or whatever, versus putting it here because we're actually backtracking in terms of, increasing the potential of immigration or whatever. And so there's a story behind, and there's values, and so you can definitely do both things at the same time. I think that's the whole point, is to try to do both things at the same time.
I have a comment and then I have a question. As I understand this, whether it's 7 or 10 years ago, J.P. Morgan created enormous excitement in the market by doing the first gin report, which had off-the-wall projections. I don't know what the team was smoking about the size of the impact investing market in the next 5 or 7 or 10 years. I'm making up the numbers, how many years, because I can't remember. But it was going to be $60 billion plus, and it was going to happen in a variety of sectors. And they actually put the team in their investment banking or investment area. Then a few years later, and then I was on the board of the Calvert Foundation. I remember great excitement and discussion about this because Calvert was looking for alternative investment vehicles. They were doing community investment for a long time, and they were looking for other models. I remember we met with Jim Wolfenson's son and the Jeff Wolfenson, and he said we wanted him to put some capital into Calvert, and he said, well, you're the old model. I'm looking for high impact and high return. So I said, well, I have a bundle of money. You find it for me. But basically, a few years later, J.P. Morgan moved that team into their foundation. And despite pumping the market about impact investing, they didn't really believe it because the team was no longer in the investment bank. As soon as that signal was there, people should have realized how confusing it was. So I have my question about this. We look at it, I'm with Roland. I think you have to start with the client and you have to start with institutions. One of the smartest people I ever met in microfinance happened to be my advisor at CGAP, Rich Rosenberg. A lot of you know him personally, but also you know about what he wrote, what his writings. And he said, look, it's about institutions. We should just fund good institutions. So I have two questions. I've always assumed that impact investing, other than microfinance, was about the ability to move funding into diverse sectors like health, like education, like the environment. We could go on, housing, and energy, agricultural value chain, and model that in a way that microfinance was able to achieve, that it would be sustainable investment, it wouldn't be subsidy driven, and that over time you could build the same kind of infrastructure, institutions that would support that, funds that would support that, reporting and information, all the kinds of things that happened. So either it was going to be extended MFIs who diversified, which is the model I originally believed in and may still believe in, or it's going to be new institutions. So is that a reasonable definition of impact investing? You're looking at diverse sectors and you're looking at institutions that can address those diverse sectors. Then the question is, where are the institutions coming from? Are there institutions on the ground? Is there infrastructure? Is there reporting and data that supports that investment? Or are we very ad hoc that Elevar does it very well, maybe another fund or two does it very well, but there's no sustainable infrastructure, no sustainable institutions, and so we have a very ad hoc model called impact investing, and it doesn't look like microfinance or what microfinance became. It doesn't look like it's moving down that track at all. I hope that's a coherent question, but that's my confusion about it.
Personally, I think it's too early to tell whether or not everything, all of those sectors that you've mentioned are going to be as successful as micro. But yeah, I mean, you could look at the renewable energy space and the amount of capital that's gone into that globally. One could argue that that actually does match some of the predictions that were raised in 2007. Agriculture, not there yet. It's a harder sector. There's a lot of challenges. There's a lot of players and a lot of mental minds that we have to undo to sort of move that model into a commercially based model. And then you have everything in between, like ed tech in the US now has, I think, 7 or 8 dedicated private equity venture capital managers that are looking at solutions. It really just depends on the sector and the geography, but I would say we are definitely moving in the right direction of more professionals dedicating time and space to a lot of these problems. Matching that capital with their endeavors is going to be a trickier part, but that's sort of the evolution. I don't think the early days of microfinance were fully funded in grand scale in the beginning, so I think that it's coming. I just think that there's a greater degree there's a greater desire for proof points earlier in a process that's all like self-imposed. We want to see success a lot faster. It's funny, you put an investor in a 10-year private equity fund, in year 3, they're like, well, where are my returns? And you're like, well, this is a 10-year fund. So let's remember like that everything takes time to sort of, it goes through a period, you have to get to the next round of funding. So I think we've put a lot of expectations, or our clients have put a lot of expectations depending upon the type of endeavor, the investment that's made. But I think personally there's a lot of progress that's being made in each of these sectors.
You would agree that one of the definitions of impact investing, given that there's many, is that it's moving into these diverse sectors that can affect the quality of our clients' lives, that can improve the quality by not only bringing finance, but by bringing alternative services to them.
Yeah, I don't disagree with that as part of the definition.
Do you want to say something?
Oh, I just wanted to touch on, you mentioned infrastructure, and I think part of what maybe is leading to the confusion around impact or whatever is that there's no, not only a way to identify what impact is, but a way to measure how much impact is being created, or, and a way to sort of put funds, not against each other, but compare them in terms of impact. And, I know Microvest also is involved with GEARS, the Global Impact Investing Rating System, and I think that tried to do that, but really it's kind of measuring the intent to create impact versus whether one fund is really better at impact or more impactful or, has more of a impact than another fund. So, yeah, which I think.
How could you?
Yeah, and how could you? Because everyone's different.
But microfinance is a credit-based product. How do you compare microfinance endeavor with building a wind farm?
So you can compare financial returns.
Yeah.
Always. But if the question is how do you compare the impact of a wind farm to the impact of sustainable finance on the lives of the people affected?
Yeah.
I think that we can really say is that there is, however you've defined, you're going to measure that impact, whether on the financial inclusion basis, whether it's, a scale of the operation, the size of the client being served and the sustainability of the institution, you can check those boxes. So that's a little bit kind of the traditional way that we measure impact in microfinance has to do with scale and depth. With renewable energy, it's going to be whatever carbon emissions you're diverting. So they're going to be, how do you equate those two things then? It really, I think, boils down to investor interest and where they are interested in having their impact.
I've spent nearly 40 years researching the lives of low-income families, and I must admit I'm very puzzled by this discussion. Where's the problem of ambiguity? It's only towards the end, within the past few minutes, that we've got to the point of the quality of lives of low-income families. That's what impact is about, isn't it?
Not fully.
Why not?
No, I don't know. Maybe I'm a bit provocative, but is that not the definition of impact investing from people coming from microfinance?
No, I'm talking about quality of lives. That means health, it means education, it means skill development, it means clean drinking water.
I don't disagree that is definitely a part of the definition of impact investing. But if you go back to the comment that the capital is driven from the clients, they don't all associate that as part of their definition of impact investing. That's the difference. For them, saving CO2 is more impactful than saving a life. Like, that's their subjectivity. That's the bigger picture. Sorry. So I don't disagree that impact for a lot of us has always been centered around low-income communities and their lives and how we can improve their lives. But when you look at a wealth manager and he's talking to a family office, they might only be interested in fisheries and agricultural ecosystems. They might have a tangential effect on low-income farmers, but not necessarily, that's not how they're going to measure it. So I think that's the only dimension that I would...
Well, I would argue that fisheries and, what did you say,
Agreed.
agricultural ecosystems are not the effects are not necessarily tangential.
Agreed, but for that investor, they're not seeing that link. Then the challenge is the wealth manager needs to create that link and then create the story to then get investing in those kinds of endeavors.
But it's even a bit more than that. I think we all agree, Sanjay, with what you say, and we all hope that there's going to be life improvement. But the danger is to fall back. I think it was you, Damian, who mentioned yesterday this promise of Mohammed Yunus. I think we learned from that experience that it is dangerous to promise. If the brand promise of impact investing is saving people's lives, then that's what you're getting into with your investor. And so we're actually a bit backtracking, saying you don't own the destiny of that person. And we're almost getting into philosophical issues of are you a liberal or what's your leaning and understanding, but and so we don't need to go there. But it's for me the worst thing, a bit as a liberal, the worst thing I could do is convince my investor that he owns that life change. What he does, the impact of the investor, is to push money where it doesn't flow. That's what he controls. He can decide to pull his money out of Philip Morris and put it in Elevar or whatever. And that's the power of his choice. And so it generates outreach. And of course, he's done his due diligence or analysis about Elevar, and he knows that company invests in a certain way along a certain process, which will trickle down and have a lot of positive social benefits. But if you do this promise, then what happens is that the private banker says, well, can you pay the impact study? And we fall in our pitfalls of the impact study is not perfect. Maybe the guy needs also to have a statement, and so it's actually counterproductive. And we don't really know what we're measuring because we're trying to measure something that belongs to the fisherman, which is his choice buying, a solar lamp rather than a pack of cigarettes or whatever. So I think it's very important, this thing of the promise, and being clear on what we're selling to our clients, and not overselling the story.
Well, I like the formulation of impact investing being raising funds from investors and putting it into areas where money doesn't flow. I really like that. But I think that's precisely the problem that we're facing in this room today, is that impact investment has become defined almost, at least in the context, I'm not talking about CO2, at least in the context of impact investing in emerging economies, has become defined mostly as microfinance. And that's what your investors have come to understand it as. And the point that I wanted to make is that at this point in time, I think microfinance is crowding out other impact investments, and putting more money into microfinance today, at least from my perspective in Asia, where there's now a lot of domestic investment in microfinance. Putting impact investor money into microfinance today is pushing money where it's already flowing. So money should be going into other areas, low-cost health, low-cost education, as I said, drinking water programs, skill development, and so on. Those are the areas that are today where microfinance was 15 years ago. And I think that's where money should be flowing. But then you've got to create that story for your impact investors. They've got to understand that this is what it's about. It's not about putting money into microfinance anymore. We do evaluations of impact investing funds. And every fund that you look at, the average amount of money going into microfinance, even though they call themselves impact investing funds that's supposed to have a wide range of activities that they invest in, 65 to 80% is in microfinance. What's the point? Yes, but why do you want to earn huge returns?
No.
Why is it important?
So I will say that from an investor's point of view, you have to have a vehicle that you can invest in.
Yeah.
So the reason why there's so much money from the private investors who are investing in impact that is directed toward microfinance is because companies like Roland's and Microvest exist, so there's a vehicle that's structured there. I think that the expectation that you go to your investors and tell them that they should be putting their money into, there are plenty of other impact, and that people always have other expectations of where they want to invest. But you can make an argument for there are other sectors that they can have even more impact because there's really no money going to these sectors. But they have to have something to invest in. So there needs to be the financial vehicle and the business already developed to invest in. So we're sort of, if you think about where money went on an early basis into microfinance, even if I look back to our first fund and who our investors were, they were 90 investors in a very small fund who had faith that this idea might work and were willing to lose their capital.
Yeah.
So really, because it was higher risk, because it was earlier stage. So you've got to kind of start at that early stage and develop the opportunity for the investor to invest their capital.
So I guess the point I'm making is that we need disruptive impact investing fund managers who will create the story that you can invest in value chains, you can invest in low-cost health, et cetera, et cetera. The impact investing world has become fixed on microfinance. And I think you need to move out of that. Elevar has an excellent investment in low-cost health in India.
Right, but we're not a microfinance fund.
No, I know. But
So-
what I'm saying is
Right, but we're not.
you need to do more of that.
Yeah, I'm sure Amy will agree.
But I don't know if I agree with the comment that impact investing is synonymous with microfinance. and only that.
The problem is that the impact funds that he's evaluating, 60-80% of the money is going into microfinance. He agrees it shouldn't be.
But then wouldn't you say, though, and maybe you can speak to this, I mean, to me, one of the big questions is, what's the pipeline? So in the case of microfinance, as I think I was mentioning this earlier to someone, we had like 25 years of matching grant money from USAID to really work, when I say we, I mean the Accions of the world or whatever, FINCA, to work on institutional capacity building of these institutions. And so, when it came down to investing, there were investable institutions out there. And, I feel sorry for any institution that's a microfinance one that is coming into being now because that money is not there. And maybe they can't become investable. I think the question I've had all along with impact investing is where are the revenue models? And if they are in these areas, which I don't think anyone disagrees with you, Sanjay, it's just that how much time is it going to take, if we take an optimistic view, how much time is it going to take to find a revenue model that will at least, bring in these investors who have their, rightly so, their criteria. And I just want, the time frame may very well be different than microfinance.
But
The problem with that is that it assumes that impact investors want a market rate of return. And it's not clear to me that that is the case.
No.
There are people.
Sure. Just like there's a wide definition of impact investing, there is a wide definition of investors.
Part of the promise in that sense that you're not necessarily sacrificing. Not that it has to be high return.
It really-
But there is that. I think that's part of the issue. The challenge of that is that
if you're
the double
working-
return.
I think you need, there's sort of a progression here.
Yeah.
And, as Candace just said, her first investors, of which, I was one through the Grey Ghost Fund, were prepared to lose their money.
But is that investing or is that like quasi-philanthropic,
It's
recoverable grant mentality?
Seed investors are often prepared to lose their money too,
Yeah.
and we ended up not losing our
Right.
money. We didn't lose our money on Microvest. We didn't,
Yep.
overall we made money.
Right.
But, we were willing to take that risk, partly because we were just not risk averse and partly because we thought that the outcome of this risky investment could be very positive, which
Sure.
indeed it has turned out to be. Now, I think to say that putting money into microfinance because it's already proven and it doesn't need money, and I think that sort of ignores how people come to this sector and the sort of thought process. I think that many of the people follow different paths, but some of them start with grants and then they start to say, well, maybe investing would not only get me my money back, but might actually be more influential if I do it as an investment rather than a grant. Other people would say, well, I'm willing to try this with some of my money and I'll get used to it and see if I like it. And then maybe over time, some fraction of them might say, well, I'm willing to risk some money and do something a little bit more, creative and a little bit more unproven. But I think, getting them in the door and getting them, acclimated to this and educated about what can happen and what works and what doesn't work is part of the process. I don't think it's any lost opportunity, because it's not as if the people who are putting their money into a debt fund would, if that debt fund were not available, would be putting their money into seed investments in health clinics in, Cambodia. They wouldn't put their money anywhere. They would leave it where it is with Philip Morris. So, you have to sort of create a path for people to follow.
Okay, just a small point. My problem is that I believe they're not being offered the opportunity.
And that goes back to Candace's original point that a lot of the newer impact investing capital is being managed by a third party. And when a third party intervenes, they have a fiduciary responsibility that's defined in some level. And so riskier assets are harder to put into people's portfolios. Those decisions to fund Microvest in the early days or us in the early days, those were individual decisions, not made through a third party. I think that's a big, and so then you have to think about the quantum of capital that's available from those individuals to continue to fuel all of this.
And it's very valuable, so you could argue that when you find that capital, you should make sure it goes somewhere
There are highest and best quote. There are other.
Yeah, I just wanted to, brand is very important in this, and what we call, this movement is going to be very, very important. A point I often make is, I think it's wise to remain with a broad understanding of what we mean by impact investing now, but it took the microfinance sector a very long time, to get to client protection standards, to get to social performance standards, and they're really pretty unevenly practiced. Let's be frank about it. And as a result, a lot of the brand equity, I guess more in the U.S. around microfinance, has really been hit. Let's be frank. And yes, Professor Yunus did get up and say what he said, and that's hurt too, right? But with impact investing, I think a very important point was made about the fact that there probably is a lot of soft money that's going to be required somewhere to begin to create the program, the social businesses or the enterprises that are going to be originated. By having a broad definition of impact investing and not being much more precise about the kind of, when I say clients, I mean poor people, outcomes, right, that we're aiming towards. We do run a risk of, like with microfinance, commercial, consumer loans being called microfinance. What is the financial sector gonna dream up to call impact investing that may not fit within what we in this room feel is impact investing? So we're going to have to come to a point when there are standards, right? And if we don't, we're going to run the risk of losing a lot of brand equity and potentially losing momentum towards creating that kind of the softer side of the financing to create the infrastructure, the institutional infrastructure to make it go.
I would say in terms of one element that I've noticed, just kind of curious from the perspective of the Europeans, I'm starting to see at least a lot of discussion about impact investing within the framework of the Sustainable Development Goals. I am not seeing that here in the United States. And so it's pretty dramatic. I mean, I think in terms of even, the Dutch funds going in front of the Dutch government to sort of discuss this. And so in some ways, I feel like that, moving in that direction, does kind of address some of your comments, Sanjay. I mean, in terms of, because they're much broader. I struggle a bit to see how one can actually frame it. I mean, or to what extent the SDG, have meaning for your investors. Are they asking that question? So anyway, I think that is one way to kind of wrap this up, of just maybe get your sense of how things are moving in terms of that element of what I would call sort of impact investing.
We, as I started saying, in Europe, the definition of the gin of impact investing is sustainable finance. And that's a very powerful frame for European investors. In most countries, there's a Sustainable Finance Association. I'm on the board of Swiss Sustainable Finance. And then we categorize the CO2 type deals, environment, or green bonds if you want. And then on the other side, there's the shareholder activism and ESG integration and so on. And then there's a little bucket, and it was very interesting because that was the bucket for impact investing, which would have been called microfinance. And so we had a huge debate. Actually, I wasn't there when it happened, and everybody was confused and said, well, how do we call this thing that's private investments in emerging frontier markets with a social purpose? And so they said, well, okay, so let's call it development finance. And then they said, well, that's too DFI-like, and it's associated with the public sector. So, okay, so let's call it development investments. And people said, well, that's not English because it sounds strange. Development investments. And so now they call it investments for development. And it doesn't mean anything. But we know that it's this thing that fits there. And so, long answer, but actually, to the point, we're all going to our clients within the frame of sustainable finance, showing the SDGs. And there's two powerful reports, one from GIN, but especially one from CGAP, who explain how microfinance addresses each and single, well, not all goals, actually goes up to goal 10, I think. And that's the conversations we're having. And so we're saying, through microfinance, but I completely understand that my definition of microfinance is much wider maybe than the one of Sanjay, for instance, for the purpose of the debate. Microfinance can address maybe with its limitations, women empowerment, which is one of the goals. It can address energy efficiency, and so on and so on. And we are having this conversation, and it happens that the SDG 2030 is really accelerating the coming of capital in this space in Europe. And Anne can definitely attest, since you're structuring all these funds in new topics beyond, let's say, microcredit, if we want.
Yeah, well, I think that in the structuring of even investment vehicles, we don't, definition of what we are doing is not so essential. You have, yes, a mission statement for the fund, but then it's a matter for the managers to convince their investors, I guess. So I'm not sure I'm the best person to say anything on this, but I guess that the reference to the SDGs is probably a good idea, because I could continue on the Swiss reasoning about sustainable finance. We in Luxembourg are talking about responsible investing, which encompasses microfinance. Well, we played around, the acronym ESG. So you have the full ESG, which is for any type of financial assets with the screening, negative, positive ESG screening. And then you have the ESG with a big E, environment. And then you have the ESG with a big S, that would be microfinance, impact finance, solidarity funds, and stuff like that. So you see, everyone is talking a different language, and I really think that we need to find something smart which makes sense and which helps, this sector not being eaten by the more global markets.
No, exactly. That's why I think the SDGs is pretty interesting. I made a comment to someone who was at a European fund and said, well, maybe it's SDGs this year, and then who knows, it'll be something else next year. But in terms of trying to look for some common framework, it's something I've definitely noticed at the Financial Inclusion Equity Council, that the European funds seem to have, it's like a North Star, which I'm not seeing with the other funds. And so that, I just leave that as a comment, because we do have people from all over, but I do wonder if some of us who are not so, living in that culture of SDG should be thinking a little bit more along those lines. So thank you all to the panelists. Thank you.